Good afternoon, everybody. It's your boy Dave P. Just know your life matters. You do have a voice. Don't be afraid to use it if you are complimenting, educating, inspiring, motivating someone else. I got a good buddy here with me today, Mr. Derek Long with Quest Trust Company, somebody that I know and I work with. I would never suggest the services of somebody that I personally did not have experience with. Mr. Long, how are you this afternoon, sir?
Dude, I am doing great, Dave. How are you doing?
Fantastic. You are down in Texas, right?
Yep, I'm physically in Houston, Texas right now.
Brother, we have snowflakes the size of baseballs coming down right now. It's a winter wonderland in Columbus today. And we are going to get into everything self-directed IRA investing. We're going to be talking about how we use our IRAs with Quest. Myself, RJ, our team members also have self-directed IRAs with your firm, and we're very pleased with the services of your firm. We're going to be talking about how we use our IRAs and just kind of what's possible, kind of fill in some gaps for some people. No one better to fill in the gaps than Mr. Long. And the contact information for Derek Long is in the description on the Facebook Live. But if you have any questions whatsoever, I also have that pulled up and we can try to get to some questions live here. Derek, first a midday market checkup. Taking a look
at how the stocks doing.
Stocks are green. Dow Jones seems to be up 0.14%, just slightly green. Let me pull that up. My little finger died. I'm sorry, Dow Jones down 0.14%. I mean, just pretty flat, I would say. One moment here.
Down a point.
My screen timed me out there. So Dow Jones down 0.15%, 0.15%. S&P up 6.65%, or 6.62 points, I should say, 0.18%. NASDAQ up 49.14 points, or 0.39%. Gold is up 0.07%. That's not the big news, though. Wanted to get that out of the way. So the big news of the day in the financial markets, everybody, and I know a lot of people are going to be giving me flack about this. Bitcoin is running hard today, up 7.5%. It's I just checked. It was 20,836. Could break through 21,000 today, which is an all-time high for Bitcoin. Congratulations to the Bitcoin speculators. But a lot of this has to do with, Michael Saylor, the guy from, MicroStrategy.
I've seen some of those advertisements.
What's that?
I've seen some of those advertisements. Yeah.
Well, you're probably talking about the Grayscale Bitcoin Trust, GBTC. They are all over CNBC. And Michael Saylor is the guy from MicroStrategy, and he is putting $650 million into Bitcoin. And here's the thing, Derek, it's not even his money. So, if and when it implodes, he won't be the one holding the bag. But congratulations to Bitcoin speculators. If you were able to hold on, it seems to be quite a green day. But that's not what we're talking about here today. We are talking, I own 0 Bitcoin. Derek, do you invest in Bitcoin?
I do not. I always tell people, man, you got to find something that you trust, feel, and if you feel comfortable with Bitcoin, you can stick with it. But me, I like to invest in tangible assets. I like to know that I can touch it, feel it, see it, look at it.
So you have a couple rental properties. We're bullish on the rental properties. Affordable housing, I feel, is the best investment class right now. I stand by that. Where are your properties at, and what are kind of the price ranges of what you're investing in?
So I have properties in 2 different states, one being Houston, or one being Texas, one being Florida, and both of them are labeled as rental properties. I will say it's really weird. When we think of from a cash flow standpoint, the ones in Texas are better cash flowing, okay? But the ones in Florida have more profit. This is because it seems like when I get a renter in Florida, they hang out longer, right? They're okay to be there, and they're a better renter too. They don't trash the place. They keep it up, maintained. So even though maybe I have more cash flow in the Houston properties, it seems like all that cash flow goes back into the house.
I've seen this quite a bit, especially in my experience in selling turnkey properties and whatnot. Sometimes the lower end of the spectrum properties, or what would be considered like a C class or lower property, looks better on paper because, you know, the cost basis generally is going to be lower and the monthly rent will allow, on paper, it's going to look a lot better. But sometimes, you know, it's not always better if your CapEx or capital expenditures continue to eat away at that yield potential. But you also do some private lending. And do you lend money out of your self-directed IRA?
I do. So even though I am a real estate investor by trade, and outside of an IRA, I own physical properties. Inside an IRA, I do a lot of lending. And the main reason why is my goal is to beat the market, right? And I know I can use my IRA, lend it to another real estate investor, noting that I already understand real estate, and I can get a better rate of return than any mutual fund or government bond, and usually even better than the stock market and stuff. And it's secured. So I do a lot of lending from the IRA.
Do you? Okay. And do you lend to local investors, or who do you personally lend to?
So when I'm doing a loan as an individual, and I want you to understand that everyone will have their own rules and regulations and topics about this. Okay. But for me as an individual, I lend in my local area. This way, if something goes wrong, I can actually deal with it. You know, I can go look at the property. I know the contractors that are out here in Houston, right? Some people would be like, hey, look, man, but I have a great lender. I have a great buddy for me out in Virginia. Well, I don't live in Virginia, you know? Not saying that it's not a great place to lend money and stuff, but you want to have your boots on the ground, because I always try to think of worst case scenario. So,
and these,
I got to plug in my computer real fast. Sorry.
You're fine. And I do think Derek made an important point, which is, hey, whenever you're considering doing any type of investment, you got to do your own due diligence. And when it comes to private lending, you want to obviously do your due diligence on the property, kind of have a general idea of what the worst case scenario looks like, but also do your due diligence on the borrower. And I'm sure, Derek, you kind of have somewhat of a relationship with these borrowers. You're not just finding people off the street, are you?
No, that's correct. As a matter of fact, a lot of times when I have borrowers, and if you look at some of the more advanced lenders, people that have millions of dollars to do this, which I don't. I wish I did. I'm almost there, right? But when we look at people that have millions of dollars of lending, they're usually not lending it out to 100 people. It's usually the same 5 or 6 individuals, because you build that relationship. You build that trust. You know how they work. You know, it's not saying that every deal goes great, but if something goes wrong, you know they're going to take care of you. So usually it's not just the property, it's the relationship with the borrower itself.
Without a doubt. And we do some lending as well. We do a ton more borrowing. In fact, many of the clients that we work with and people we borrow from, they have self-directed IRAs with your firm, with Quest Trust Company. And we are actually introduced to your firm, and give a big shout out to the folks. I'm drinking out of their wonderful Yeti cup that is here in my hand, but all the fine people at the Freedom Founders Network, and really can't say enough good things about the team over there, and especially one of the most influential people in my personal life, Dr. David Phelps, the founder of the organization. And I know he had been good friends with Quincy Long, and he's the founder of Quest Trust. Is that correct?
That's correct. So Quincy's my uncle. He is the founder of Quest, and we've worked with Freedom Founders since day one. And you're not kidding. Those guys mean business. They understand what investments look like. And not to hate on anyone out there, but these are some of the most wealthiest individuals that I know, part of the Freedom Founders group. And their money's not in Bitcoin.
Well, I don't know what they do with their money, but I will tell you, it's not up to me, but I do know David Phelps has really, trained us and taught us many things. And one of the things that he is big on is not being a speculator. And, I do feel Bitcoin and cryptocurrency is quite speculative, but what David teaches is really, he's bullish on affordable housing as we are. In fact, he was the first person back in, I think, 2000, I want to say maybe 17, when he first actually came to Columbus, Ohio, and visited RJ and I at our office. And really, the Freedom Founders Network vets everybody out. not only the members, but also the trusted advisors within the organization, which Quest Trust happens to be, as well as RJ and I. And David had come and was vetting us out and was explaining, I love the affordable housing markets. And I just wasn't mature enough financially in my mind and smart enough to understand why, and it all kind of made sense over the years. In the affordable housing cash flow type of markets, in a worst case type of scenario, when somebody loans money, if we were to take this property back, or the lender was to take the property back as a rental, or us as the person who's rehabbing the property. We specialize in rental properties. We only do rental properties. But if we were kind of flipping a property and speculating on a property, if we had to take it back and we couldn't sell, something happened in the financial markets or in just the real estate market, if you could cash flow an asset and ride the storm, you're going to end up in good shape, So we do a lot of affordable housing, and I know the Freedom Founders Network is not a speculative type of network, but for us, we borrow from private lenders all the time, many Freedom Founders members, and they lend out of their self-directed IRA. Do you work with people? We're going to get into kind of the loan structure and some of the things that we do, but what about owning property with a self-directed IRA? Do you work with people who do that as well?
We do. So it's really funny is when people come to us originally, a lot of people think they want to own property inside their IRA. But I always tell people, and this doesn't matter whether you're at Quest or any other custodian, it's actually one of the most tedious investments to own inside the IRA, right? And there are some ways to make it easier by adding extra levels of LLCs and trusts and those type of things. But normally, you don't want to go about these motions. And when we see the more advanced people, and some of the people that actually do, I'm going to say 15, 20, 30 deals in a single year, these people will start doing more loans out of the IRA versus owning individual property. But I'd say probably about 40% of all of our clients across the board at Quest own physical houses one way or another.
Please define a checkbook IRA, and is that something that would be used for the ownership of real estate out of an IRA?
So if you are interested in one of those checkbook IRAs, I always tell people, make sure you're reading a very up-to-date article. Okay, a lot of people will base things off of a court case that literally came from the 90s, and I'm not exaggerating. And they call it Swanson versus Commissioner. But a lot of the custodians have changed what the definition of this means now, right? And the definition of a checkbook control IRA is the IRA in one way, shape, or another can write a check that is not tied to the custodian. Okay, so Quest in this case being the custodian. So what does that look like? Normally it means the IRA needs to set up its own entity, meaning an LLC, a trust, a C Corp, whatever you want, right? Depending on what part of the country you're in will kind of determine what type of entity you want. And then you have to bring in a trustee or manager to hold that checkbook for you. So I know you're actually going through this motion yourself right now, right?
Well, we are creating a trust and doing a real estate transaction because there's multiple members within this particular trust. And we're just doing it to get multiple people. So myself is involved in a transaction, and RJ is involved in the transaction, and then one of our team members is involved. And we needed guidance on how to best structure this to keep it as clean as possible. And we took the direction of forming a trust and kind of creating this way on the trust for the property that's being purchased. It's just going to show the trust as the buyer.
Yep.
And then there's a trust agreement, which spells out the roles of the various IRAs within the trust, and then how proceeds and disbursements are going to be allocated. Is that correct?
That's correct. And that's the most common method to go about it. And like I said, the only thing that you want to make sure that you do in this, and you guys did it right? Whereas you have a additional trustee or an additional manager or something like that that's actually labeled on there as that person. For you guys, it was a trustee, and I think it starts with a W. Thought his name was the attorney guy that drafted documents.
Yep. And just so everybody, because sometimes we start talking IRAs and we start talking trusts and people get all confused. Guys, The attorney who drafted all this stuff up, he's just the attorney over at the title company, guys. This is all it is. This is not this confusing, go hire an attorney and call somebody on a billboard and do this. And a trust is nothing more than an entity that's created at the closing table, essentially, or at the same title company. And you work well with our title company. You guys are in pretty good communication.
Absolutely. Yeah, we've been in contact every day, that they need us.
So quick plug. If you're in the Ohio area, I know they've branched out, and especially in Central Ohio, PM Title does a great job, and I'm happy to refer them as we do quite a bit of work with them and other title companies locally. But since we're having the conversation about that particular deal, thought I'd give them a plug. Thank you, PM Title, for all that you do. And this particular deal, so there's 3 members involved, but it's not equal participation, right? So RJ and I are funding a certain percentage, we'll call it 70% of the deal. And the other member, who's one of our team members, is coming in with the 30% of the deal. So creating a trust and then spelling out, who's funding what and who's receiving what on a separate document, which is that trust agreement. What that prevents is having a purchase and sale agreement, which has, the buyer is Dave's IRA, 70%, a million numbers and this and that. RJ's IRA, or 30%, million numbers. Other person's IRA and all this. So it's too convoluted. When you create this trust and then have a separate trust agreement that which spells everything out, it kind of keeps it a little cleaner, right?
Absolutely, right. And it does. And it's a great way to bring money together, right? I see a lot of people do this with their family, especially when it involves like their kids. People don't realize this, but you can set up an IRA or an ESA or anything like that for your kids and get them involved in this. And this is what my dad did with me. And when I was graduating high school at 17, I didn't care about my IRA or anything. I really didn't. But that was the thing. My dad was still forcing, and he did it for me. And then as I got older, I took it over, And I learned along the way with him, which was really unique. And I started off this really small account that I was able to start building myself. So it's a great way to bring money together, even no matter what the dollar figure is.
Sure. And, I know we're getting pretty advanced, but let's just kind of get into the mechanics of what is a self-directed IRA. So I'll kind of do it in my own words, and then you can fill in some of the gaps. So an IRA is like any IRA. An IRA with that, somebody is building a stock portfolio in is the same IRA as what you guys have, except yours is a self-directed IRA. So you could use the money for real estate. And if you were to create an IRA at Wells Fargo or Chase or, TD Ameritrade, you can't use that money for real estate specific transactions. You can only invest in the vehicles in which they approve of, which is most likely going to be, various capital indexes and stocks and things like that. So they don't let you do that. So you need a custodian, which is real estate friendly. And that's what Quest brings to the table. But the rules of the IRA are the same. So the contribution that you can bring to the IRA of after-tax money is the same exact amount. How much is that amount that someone can contribute of their after-tax money every year?
So if we're talking about a traditional Roth, it's going to be $6,000 or $7,000 if you're over 50. If we're talking about one of those employer plans like the Solo 401k or the SEP IRA, it's usually around $57,000.
Okay. So let's just stick to the traditional Roth IRA. And we've already identified the rules are the same, whether it be a TD Ameritrade Roth IRA for stocks or a self-directed IRA for real estate. And the rules are the same. So you can contribute if you're under 50, $6,000 per year. And then with that money, it goes into the IRA and you can use that money for investments. And then let's say you go out and flip a house with this money or do a loan or something like that. The proceeds or the interests from the loan or the flip, that money has to go back into the IRA. Is that correct?
That's correct. So I always tell people, if you ever hear the term self-directed, it's made up. It's a marketing term. I always like to tell people there is no such thing really as a self-directed IRA. And you described it perfectly. It's because an IRA, no matter where it sits, it's the same thing, right? Just custodian A lets you invest in stocks. Custodian B lets you invest in real estate. So you just need to find a custodian that lets you invest in what you want.
Correct.
So,
And the rules are the same though.
absolutely, 100% the same. So knowing this, when Quest sets up your IRA actually will be its very own entity. It has its own name, its own address, its own signature, even its own level of asset protection. This means like if you said you're going to go do that fix and flip, well, you might be going through all the motions of finding the house and making an offer and working with the agent, the title company, the bank if it's debt leveraged. But when I read the buyer's name on the contract, it's no longer your name, it's the IRA's name. This means the IRA buys it, the IRA will sell it and receive all the profit.
So all the profit goes back into that IRA.
Mhm.
And then when are we able to access that profit?
So typically I'm going to tell you 59 and a half, right? So you have to be 59 and a half to start removing money, penalty free. There are certain circumstances though you can remove money earlier from things like the Roth IRA, completely tax free to benefit yourself. So,
and we won't get too far into that, but you can. Let's pretend that I contributed $6K for the year, and I used that money as part of a deal, and I turned that money into $10K. So there was $4K profit. The $4K profit goes back into the IRA. I cannot pull that $4K out tax-free until I'm 59 and a half, but I could pull out my initial investment of $6K anytime I want because I've already paid tax on that money, correct?
That's correct. I like to think of the Roth IRA almost like a savings account. I mean, if I put $5,000 in my savings account tomorrow, can I touch it? Sure thing. And the Roth IRA works the same. And that's something a lot of people miss. They don't realize you can remove your contributions whenever you'd like.
Mm-hmm. Okay, so I prefer the Roth IRA. So let's define, because it's really not that complicated, and we're keeping things very simple. I need to keep things simple, or else it's going to spin my head around. Because quite honestly, it's a lot of intimidating words and stuff, but it doesn't have to be that complex. In fact, if you're watching this and you are somebody who maybe has been intimidated, my intention here today is to help simplify everything. If we can help simplify this stuff, it will serve. We got a couple questions coming in.
Sure.
Corey Boatwright is giving me flack about crypto. Cam Kelly, Quest information. It's Quest Trust. It is in the description. It is Derek, DERRECK.long at questtrust.com. So let's identify the difference between a traditional IRA versus a Roth IRA. Fun fact, and correct me if I'm wrong, Roth was actually the name of the guy who got this passed, right, through Congress or something like that. Where did the name Roth come from? Roth IRA.
It was from a guy named Senator William Roth, okay? And it was pretty much passed in 92 to 93. It's right there at that the window. And what it really, truly was designed for is, and I don't care what your political views are, if we look at things like Social Security, right, we can tell that it's been slowly diminishing, right? So Senator Roth realized this and wanted to put something in place for the next generation, all right, to where they can grow wealth tax-free and take care of themselves from it. So the Roth IRA is one of the most powerful tools in that standpoint.
So first, I want to get into the difference between a Roth and a traditional, and then I want to kind of talk about using IRAs with our children, okay? And then we'll kind of start to put a bow on it from there. But first off, the difference between, and correct me where I'm wrong, between a Roth IRA and a traditional IRA is with a traditional IRA, you can, let's pretend we invested the 6K and in our first year, we turned the 6K and made a 4K profit. The 4K goes into that IRA. And now I have 10K that I can continue to use for investments and grow. And that is not tax-free. So when I turn 59 and a half, basically, if it was a traditional IRA, the taxes, and I'm ready to pull that money out, are just deferred. So now I'm in the tax bracket of whatever time frame I'm in when I chose to pull that money out. Is that correct?
That's correct. And man, I'm going to hire you.
Let's go.
But you're right. So the Roth IRA, whereas you already pay taxes on the money that you put in there. So when it grows, it does grow tax-free. Imagine by the time you hit 59 and a half, let's say you had a sizable account. We're going to say 100,000 bucks. Okay. You could do a fix and flip 100% tax free and touch the money. You could own a rental property. All the rents that come in completely tax free, right? So the Roth is really where it's at. Whereas if I did that in the traditional, I don't owe taxes on the money I put in there. I owe taxes on the big amount, right? So not on the $6,000, but on the 100 grand. And so that is really the difference between the traditional and the Roth. And you described it perfectly.
Well, thank you. Here's, and I learned from you guys, man. I mean, we've been doing these calls for years, and here's the big one that I want to convey to everyone is, you know, I understand the benefit of deferring taxes. So you can, instead of paying taxes on that money, let's say you earned a yield, let's say you go back to our example, you made a profit of 4K, you don't have to pay the tax now. So you can keep that 4K working, keep those soldiers working for you to make more money. However, when it comes to deferring taxes into the future, we don't know what the tax brackets are going to be in the future. And if you look back historically, taxes are around, 20, 30% right now. It's just kind of like that. I'm just throwing general numbers, simple math right now, different strokes for different folks and income and whatnot. But, it's actually historically low. And I think if you talk to many economists, with all the money that's being printed right now and, with the interest rates being artificially low, and like taxes are suspected to go up, not down. Would you agree in your?
Yeah. And even if they stayed right where they are, if you do it right and you grow your retirement account properly, you should be in a higher tax bracket. Okay. And people don't realize this. If I take a traditional IRA and I grow it to, let's say, $1 million, all right, that's unfortunately, it's not unrealistic. And really, we need more than $1 million nowadays to retire. Okay. But let's say, hey, I'm fully going to retire. I have $1 million in my traditional IRA. At 72, the IRS will force you to pull this out in increments between 72 and the day you die, right? And believe it or not, if you don't know when you're going to die, the IRS has a chart for it.
There you go. Yeah.
Right? Now, if we do the math on it, it comes out to around in between 50 to 80,000, depending on the year, that you're forced to pull out every single year. So let's just go right in the middle and say 60 grand. If no matter what, I'm forced every single year to pay taxes on $60,000, ignoring any other income I have, ignoring anything else I do, that will be the lowest tax bracket I'm in for the rest of my life. And so that's really scary to think about. If we just in this year, that's 20%. The lowest bracket I'll be in, assuming I make no other income, and I'm just trying to live off that $1 million, I'll be in a 20% tax bracket. And that's scary.
Why would anyone choose a traditional IRA over a Roth IRA?
And I'm sorry for all the CPAs out there, okay, but I blame it on the CPAs. And it's not their fault, all right? Their job when you go to your CPA is to do what? To find you a tax deduction, to decrease your taxes today.
Correct.
You're not always looking for your best interest 10, 15, 20 years down the road. That same $6,000 we put in the Roth, if you put it in the traditional IRA, depending on your income bracket, you can get a tax deduction. Man, a $6,000 tax deduction doesn't sound too bad. It really doesn't. And that's the issue, though. That's why it grows tax deferred. But if you can suck it up and you're like, hey, you know what? I'll find a tax deduction elsewhere. I'll take a tax deduction using a health savings account. I'll take a tax deduction by, either, contributing to some other charity or something like that. That's where you should be taking those tax deductions, not from the IRA.
So if I had a traditional IRA, could I convert it into a Roth IRA?
Absolutely. Absolutely. One of the most common misconceptions is, well, my CPA said I make too much money to contribute to a Roth. That's actually wrong. There is no income limit to contribute to a traditional IRA. And there is no income limit to convert that traditional to a Roth. Meaning if you are going to go through these motions and you're like, hey, my CPA said I made too much money to contribute to the Roth directly, you just put it in a traditional, you fill out a conversion form, and then Quest will do the conversion for you. And it's free.
Okay, that's interesting. What is the cap where if you make that much money, you can't do a Roth?
So it depends on whether you're filing single or jointly, but it's right around, if you're doing a joint file because you're married, it's right around the $210,000 range. Like just Google it. It's right there, you know.
Derek, I'm not Googling anything. I have an expert on my show. I need exact answers. I don't trust Google. They censor it. I got another question for you. So that makes a lot of sense though. Okay, so that's a good point. Roughly 210 or whatever it is. If you make more than that, then you are forced to go the direction of a traditional IRA. When it comes to these, let's talk about some lending deals. Okay, so we really like working with private lenders who lend money to real estate investors for the use of flipping houses and stuff like that. When a lender or a private lender lends the money, they're the mortgagor now, right? I mean, they're the bank, right? I mean, are they protected just as if a bank would if a loan went bad or something like that?
That depends on the lender and how they structure the deal. All right. So if I'm lending money, I always say that I'm the bank, I'm going to make the rules. Right. And I know this sounds bad, but if you're the borrower, right, the borrower should not be dictating what the lender does. Right. So if I'm the lender, you and I are going to talk about what I expect. So something that I want to lien on the house. I want some sort of security. Okay. At first lien, I have even done a second lien loan before. Okay. Doesn't mean it's bad. Right. But I have some sort of security. I mean, if you don't pay me back, I get to keep the house.
Sure.
I also have my attorney draft up the documents.
Mm-hmm.
You know? And it's fair, right? If it's my money, I want to know how I'm protected. I don't want to use my borrower's attorney because the borrower's attorney will be covering for the borrower, right? That's who their best interest is in. Now, some people could argue with me on this, but I always say, man, if it's my money, I want to know how I'm protected. So these are things that I require. Is that right or wrong? No. You can do it however you want. It's your money.
And we'll take it back to Freedom Founders, since that's what I'm drinking out of today. Thank you for the Yeti, by the way, all the fine people over there. But that's one of the things they do is they vet out the trusted advisors and the paperwork, and every deal that we do, whether it be a Freedom Founders member, the majority of our private loans come from Freedom Founders members. There's a first position mortgage on the property, which is a lien. That means first position. There's no other liens ahead of this property. And then we also go through like a rigorous checklist of a lender's insurance policy. And if you don't know what that is, that just ensures that they are the first position lien the day of the closing. So if there's no back property taxes or anything like that. And we go through a whole checklist. I know Quest is very rigorous as well. So as soon as we close a deal, they have to approve every note in paperwork. And then they need the signed documents within a short window of time. Our team gets that over to you guys. And that's kind of what
you guys are awesome. I wish all of our clients were like you.
Well, you know what? I wish all of our lenders worked with Quest, because you guys make it easy as well. And once we kind of have a system together, and if you're watching this video and you're considering being a private lender, I highly encourage you checking out Quest Trust, and Derek's info is in the description of the video, but I'll reference Derek.Long, and that's DERRECK.Long at questtrust.com. And we borrow from private lenders all the time, and they use their IRAs, and we pay them back interest. The interest goes back into that IRA. It is growing tax-free. And we talked about the difference between a traditional IRA, which is taxes are deferred into the future, and a true tax-free environment after the age of 59 and a half, which would be a Roth IRA. And I wanted to get into somebody who's got a 401k. Let's say they're working right now and they feel the stock market is very frothy. I mean, do you follow the markets? We did a quick market update. It's insane what happened. And you know what a lot of this is, everybody? The Fed has hit the gas pedal and printed $3 trillion. What do you think's going to happen to Bitcoin? What do you think's going to happen? Not to mention the interest rates are so low right now, Derek. So many people are doing cash out refis on their rental properties and stuff. Everybody's flush with cash and they're just sticking it into the stock market. Everybody's downloaded the Robinhood app and pumping the market that way. People are buying crypto. People are buying everything right now. It's just, it's really a giant bubble being created, in my opinion. But if somebody's got a 401k with their employer and they would say, you know what, the stock market feels like it's pretty frothy right now. I would like to get this money out of my 401k and put it into what Dave and Derek are talking about, a self-directed IRA. What does that process look like?
We have a few options, okay? And to start off, typically in any other year, you normally cannot move that 401k until you have separation of service, quit, fired, whatever, laid off, something like that, okay?
That's the golden handcuffs, right? That's kind of the golden handcuffs of a corporation working for a corp, right?
Absolutely, right. And it's because and this doesn't make it bad, but the reason that those 401k companies contribute to your 401k is they get a tax deduction. So they're not going to let you move it. But I said in any other year, we're in the year 2020, okay? And we only have about 2 weeks left, thank God, to some degree. However, in 2020, Congress came out with the CARES Act, which allows individuals to remove $100,000 from their 401k penalty-free. Now, if you take advantage of this, you can remove the $100,000, and we've seen a lot of people then take that same 100 and move it into a self-directed IRA so they have control, so they can choose what they want to invest in. If you want to do stocks, you choose your stocks. If you want to do cryptocurrency, you choose the cryptocurrency. If you want to do real estate, you focus on real estate and you do the lending or the properties. Now, this option is only available for the next 2 weeks left. So it's been going on for the entire year 2020. Will it be extended? Possibly, right? That's up to Congress. So we'll see what happens there. But normally, to move over a 401k, you do have to have separation of service. Quit, fired, lost your job.
Got it. And you can, if let's say you're working at a corporation and you have a 401k over there, but you kind of wanted to dabble and you wanted to get a self-directed IRA going, you could just create one on your own, right? I mean, it's not one or the other, right?
That's correct. So especially if it's an individual, like a traditional Roth IRA, those contributions have no bearing on your employer plans, like the 401k.
Yeah, it's your money. You can pretty much do what you want with that. And the final thing that I wanted to touch on that I think you can add a lot of value to, and this is going out to my business partner, RJ, has a little baby now. She's 2 months old already.
That's RJ.
Yeah. And now, how would one go about setting up a self-directed IRA for their child? Because don't they need to be working? Like, doesn't the child need income? Can we just use the little child as like a little marketing for a postcard or something?
Absolutely.
And how would we need to pay this child for their marketing services? So would it be a W-2?
So you have two options. Okay. The first one, you actually don't even need to pay them. All right. You can set up for
more money for Uncle Dave. Great. That's what I want.
You can set up for any child an ESA or a Coverdell account. Some people call them CSUDs. Now the contributions are really small. It's only $2,000. However, this grows just like the Roth. It grows completely tax-free. However, you can touch all of the earnings today, but it has to be used for school expenses. Now, when I say school expenses, tuition is definitely covered, but what are some other school expenses? Things like backpacks, school supplies, laptop computers, uniforms, if it's private school, even certain after-school activities like band or something, So a lot of times you're like, you know what, this is actually a great account for a child starting off, because they're going to have a lot of school between now and the age of 30, Ignoring that, if you're like, you know what, no, we want to establish a Roth IRA for them, you do need to give them some form of earned income. Like you said, W-2 would work, 1099 would work, Schedule C would work. 1099 is probably the most popular just because it's, you're paying your kid. Pay them to, like you said, model for a business card.
I want to get back to the Coverdale accounts because that sounds very interesting. And you guys do those accounts for people as well, right?
Absolutely. Not only do we do them, but if you are setting one up, we give you a little gift basket too. So it's almost like a gift for a kid right now. So it's yeah. So we have a lot of grandparents set these up for their kids, and they get like a whole little gift for us. So they can give it to them as a
I
present.
love that. That sounds amazing. Well, we do have a question here from Mr. Phil Arthur, United States Marine veteran. Thank you for your service, Mr. Arthur. Good buddy as well. And he asks, Derek, I know you can't roll over all funds, i.e., close out the account with the employer, golden handcuffs, as we were talking about. Ever a circumstance where I can roll over a portion?
So this depends on the size of the company, okay? Certain companies, especially smaller ones, will let you roll out what you contributed, right? And they call it an in-service rollover, okay? If I work for like Walmart, they're gonna tell me no, get out of here, right? But a lot of times when we don't work for these giant, humongous corporations like Walmart or Amazon or something. So a lot of times the smaller the company is, the better chance you have of doing what they call an in-service rollover. Now, Phil, if you have your TSP 70, okay, and you have that TSP from the Marines, you let me know, because they're, depending on your age, you might be able to roll out that entire balance. So any military personnel, I'm ex-military as well, so I got a lot of knowledge in that TSP area. You might have extra things you can do to roll it out from if you deployed while you were contributing. A lot of the money might be in there after tax that you didn't even pay taxes on anyways. So if you want questions about that, Phil, personally, just send me an email and you and I can have a conversation.
Mr. Sean Huss has entered. Mr. Huss, how are you, sir? Hopefully you're still rocking and rolling. I'm sure you are down in Southern Ohio doing loans. We've done deals with Sean, but let's go back to the Coverdale account for our kids. So RJ just had a baby 2 months ago, Leonie, and you said that the best play for a parent or grandparent or anyone to set up a tax favored account, right, for a child is not setting them up a self-directed Roth IRA, but a Coverdale account. Is this correct?
Well, yeah,
and it's used for education.
Yeah, it's always one. It's not that one's better than the other. They're just different. Notice the Roth IRA, when does my child get to really benefit? When they're old, right?
Yeah.
Whereas the ESA, they get to benefit today. So, but if I start leveraging the ESA now, right, especially as a young child, they get to understand what we do as investments. Imagine if by the time they were 18, they saw what their Coverdale could do. Would they be more inclined to leverage and utilize a Roth? Heck yeah. And all of us wish we started, saving money and stuff when we were younger. None of us did. We like to think we did. Some of us did better than others. But
I collected baseball cards. That was my thing. They're all worthless now. So,
yeah.
Yeah. But it's what's going to happen to Bitcoin in 5 years. So, people say I invested in that. So the Coverdale accounts, you can contribute $2K. Mm-hmm. Is there a max or minimum or max on the annual contribution?
So there's no minimum, but the max is that $2,000. So I always tell people, if you're going to set one up, have an investment lined up. All right.
Okay.
Because you don't want to just put $2,000 in and not do any investments. It doesn't do any good for you.
Okay. I like this. We're creating a play right now. So max is $2K, have an investment lined up. So RJ could create this Coverdale account, fund it with $2K, and that could be it could be a rollover from his Roth if he wanted to.
No, it can't. So it always has to come from your checking or savings account, right?
Okay, fair enough. After tax money.
Yeah.
Yep. Earned income. He funds Leonie's account with $2K, and then she could be part of this trust agreement on a house we flip or something like that, her account, right?
Absolutely.
Okay.
Absolutely.
And the terms are spelled out. Let's say the terms are, she's going to receive, it could be a percentage on her money. She can get 20% of her money. She can get a piece of the profit. It can be, $25,000 worth of the profit, right? It doesn't matter if it's an arm's length transaction, right?
So, yes and no. This all depends on how it's structured, okay? If RJ is involved in the deal, like RJ's IRA, and then his daughter's ESA are involved, they're disqualified from one another.
That's fine. But if it was me, who's a completely disqualified party, and then Leonie's Coverdale account, my IRA, and some other third parties, not even a retirement account, could just be regular, right?
Absolutely. There you go. So, and
Okay.
we see that all the time. We see a lot of times people will leverage a small ESA, right? Hey, man, we're putting $500 in the deal, but we're going to get 20% back. What's the ESA bringing to the table? The knowledge of the deal, right? They're bringing the investment, right? That's why they get such a big rate of return for putting in a small dollar figure. I see it every day.
So RJ creates this education account for his daughter, and that is part of one of a real estate deal, and it turns into 10K, and that is tax-free, and then that 10K could be used for when she begins going to school, right? Anything school related, from laptops to crayons to coloring books to finger paints, the whole thing.
Kindergarten up to age 30.
Okay, so K through up to age 30, interesting.
Yep.
And so that's probably more of a play when she's only 2 months old at the moment. But maybe get it started now and start building up. I mean, costs are only going up, and if you're going to make, earn some tax-free profits for your child, it's never too early to start, right?
What's nice too is if you think about it, right now you can, if you set up an ESA today, you could put $2,000 in. January 1st, you can put another $2,000 in, right? If I know that I can only contribute $2,000, and since the ESA was created, the contribution limit has never gone up. Okay, it's been around since 1997. I'm a nerd. Okay,
I'm a nerd too, bro. Trust me. I mean, I'm basically a hermit at this point. I live on a perpetual Zoom call. What does ESA stand for?
Education Savings Account.
Okay, that makes sense.
Some people call them a Coverdell because in the IRS publication under 970, it's called a Coverdell Education Savings Account. Most custodians and people just shorten it for ESA.
Well, folks, we have been on the phone a little while here, and I never get enough. I can do these calls with Derek once a week. I know he provides a tremendous amount of value. I'm over here taking notes too, guys. I mean, I want you guys all to see. When I get on the phone with Derek, with everything from down here, we're talking to ESAs, we're talking Roth, we're talking traditional IRAs, and he is just a wealth of knowledge. And just as he makes himself available to me, he's very responsive with his email. And once again, his email is in the description of this live video. Derek, just hang out. I'm going to end the live stream and I'll wrap up with you. But contact Derek Long at Derek, which is DERRECK.long at Quest, QUEST, Trust, TRUST.com. You got the double T in there, so make sure you spell that appropriately. But reach out to Derek, let him know Dave P sent you. And Derek, brother, I just truly appreciate you taking the time with us all today.
Dave, this was awesome. Thank you so much for having me. I appreciate it.
Filling in a lot of gaps here for us. We look forward to continuing our business relationship with Quest. They are the best, and I hope everyone has a great day.